Hey guys, back with another video, and today I'll be showing you my 5-step silver bullet model, where I'll go over my entry criteria, my live entries, and also how I journal every trade. If you guys haven't yet, make sure you hit the like and subscribe button down below. Now let's get straight into the video. Step number 1, higher time frame delivery. Every single one of your setups should have some kind of bias behind it. And this is all going to be built off of the higher time frame. So this could be either a sweep of a high of day, a sweep of a low of day, a sweep of a previous session low or high, or a fair value gap. And that's going to be the most common. And I'll show you guys how to easily identify that. So right here in this example, we have a 30-minute fair value gap. Price is trading down into it, and we immediately see the effects of it during our New York AM session. So this setup is going to have an obvious bullish draw on liquidity, which is going to be these highs, because we have this higher time frame delivery. Now let's look at another version of this. So let's see the bearish version. So let's just say we're trying to short. The move that we get here is more towards PM session. So let's just say we're trying to shorten here. We have our context. There's no way we're going to be wanting to go long in this scenario because we have this higher time frame delivery. Now, what does that look like on the lower time frame? Well, typically when we're trading down into a discount PD array, we're going to see a fast reaction. And that's all going to coincide with all of these confluences right here, which I'll show you guys. But let's keep going. Let's get some more context and so we could see what I'm talking about. Okay, so again, right here, our higher time frame delivery, it keeps showing up. Let's see right here, higher time frame delivery, it always rules. Okay, so the higher the time frame, the more significance it has over the trade. Let's see right here, have an inversion, price perfectly reacts off of that. So we have to put ourselves in a scenario where we're in a good position and we can execute. Let's look at this right here. This 15-minute fair value gap, during our AM session, we could see that we initially traded off this hourly, and then we had this 15-minute. That continues into our AM session, kind of giving us our bias for the day. And so all of our setups need to have this. If we don't have higher time frame fair value gaps, it's because we're trading in chop. It's because it's not a high probability setup. So how do we combine these things so that we could have a profitable trade? Well, let me show you. So let's say in this example, we have a fair value gap sending us higher. We're looking at some of these highs in here. So how do we use this with our model? So the first thing we have to identify is a market structure shift. That's going to come in the form of displacement through a swing high or an inversion fair value gap. So in this instance, we have an inversion fair value gap. Okay, so let's see another instance where we have just a market structure shift. Let's say we don't catch that initial trade, but we have this market structure shift through here. So that's enough to tell us, okay, that's our entry criteria. So far, we have 2 out of the 5 things. The next thing is going to be low resistance liquidity run, SMT, data high or low. Now, there's a lot of different things that are going to give us extra confluence into our trade. And these are those different things. The most common one we're going to see is a low resistance liquidity run. And right here, it's very obvious. All these highs in here are evident of a low resistance liquidity run. When you have a bunch of built up highs like this, we know they're going to get ran through. We know we could take a trade right there. Okay, so let's see an example where we have a data high and a data low. Now this is a great example of a trade that I would take with the data high slash data low. Okay, so looking at our criteria, what do we have so far? Well, on the higher time frame, you could see that we took out sell side. We took out some significant lows, which was this lunch New York session low. We have this London low that's taken out. And we only have this data high that needs to be taken out. Where is our first market structure shift? Well, we have a few in here. So our initial one is going to be this. We're also going to have a clean market structure shift through here. And then we're going to have our data high, like I mentioned. So those are the three things. Now, going into our entry model, where are we looking for a trade? Well, in here we have two different trades. So even though I use my inversion as one of my identifying factors for my entry criteria, it's also one of my entries. So right here, where would I enter? The top of this inversion, targeting that data high. Now, what is our other entry model? A fair value gap. So either one will work. What happens sometimes though is the inversion, you could be a lot more flexible with it. Whereas the fair value gap, it's kind of like, well, you're going to re-enter on that fair value gap. It's not like you're going to enter all the way up here because we created a fair value gap. Like, that's not typical. So most of the time, there's a trade-off. You're going to get less risk to reward if you're using the inversion, but you're going to get a better entry, but you're going to miss more trades when you're trading the fair value gap. That's my model. And most of the time, I'm trading the inversion fair value gap. Most of the time, if that's present, because that gives me an immediate reason to enter. As soon as this inverts, I'm up in here, but my stop is a little bit tighter and I'm not getting the best risk to reward. Okay. Now, what are the other conditions? The final one is going to be choppy or not choppy. In this instance, we're pretty choppy, but what makes a difference in this setup from going long in here? Look how significantly larger the candles are in here rather than here. Look how significantly smaller they are in here from in here. Okay? Now this is the part where a lot of people get it wrong. They think all price action is the same. The reality is it's really not the same at all. Because displacement is when we know that market makers are on side with us. That's what displacement is. It's this heavy, large candles that are bringing a lot of orders into the market. And we want to be on the side of the whales, the people that have all the money, not just retail. We want to be following people that have all the money. And these large candles are telling us that we're getting a lot of displacement, a lot of orders, and ultimately we're on the right side of the market. So that's why we're entering in non-choppy conditions opposed to choppy conditions. Now let's break down some more charts. I'll show you guys how am I grading these other trades, what am I looking at, and exactly how I find my entries. Going back to the initial trade I was showing you guys, this is the 30-minute fair value gap. Now let's break it down and show you exactly what I'm looking at. So on the lower time frame, this is our first market structure shift. Okay. And then we have a bunch of low resistance liquidity up here. And then what is our entry model? Well, there's a few in here, but I'll show you guys the best entries. The best entry model is right here. Obviously, you're catching the bottom. Okay, where's the next one? If you miss that one, in here. Inversion. So then where does my fair value gap come into play? Right here. Why is this a good fair value gap? Because we close strongly through these highs, through these swing points. So there's so many entries, but this is all built off of the idea of the higher time frame. We're just following order flow on the lower time frame. How many PD arrays do you guys know about? There's so many in here. But if we could have a simple, clear way to enter trades, a simple way to find high probability trades, then I'm all for it. Okay? I'm always using the higher time frame. I always have a market structure shift. I always have one of these three things that are aligning with my trade. I always obviously enter on my entry model, which is a fair value gap or inversion. And I'm always looking at chop. There's a huge difference from this fair value gap to this fair value gap. And that's going to take time, guys, for you guys to learn. There's a huge difference between, like I said, this fair value gap and this fair value gap. Look at how significantly larger it is. Look at how we came down into a discount. We're obviously disrespecting bearish fair value gaps. And then we're just melting, we're cutting through all of these highs. Now, that's something that's going to take time. It's going to take patience to learn. And a lot of you guys are going to have patience or you aren't. And the reality is, the patient person is going to be the one that wins. So you guys really have to lock in. You guys have to journal, and I'll go over that. You guys have to really continue to get better every day if you guys want to get good at this entry model. Here's a good way to journal this type of entry criteria. Now, down below, I have two different pictures. One is going to be my bias, which is built off the higher time frame, and the other one is going to be my entry. Now, these are just as important as the next. However, let's look at what I write down. So it's so simple. There's no reason why you guys cannot be journaling every single day. It's going to be this. What's my criteria? Higher time frame delivery. We have my 5-minute inversion fair value gap through here. We have a lower resistance liquidity run at these highs up here. You can see through that right here. We have my inversion fair value gap. Now we had some other fair value gaps right here, but I don't write them down because that wasn't really my entry model. And then choppy or not choppy. So it was minimally choppy at first. It did get choppier later, but I managed risk. I went break even. Right here I mentioned where I'm getting break even at. So this kind of shows you guys how simple it is to journal your trades. Because a lot of you don't have a proper model. A lot of you don't have a specific criteria. So I go in here, I put in all of these reasons why I entered. And if one of them are missing, then I know something went wrong. If I'm in here and I'm like, oh shoot, I entered on a fair value gap, but there was no higher time frame delivery. In fact, it was opposing to me. And that's the reason why it was probably a losing trade, or that's the reason why it was probably a super choppy, like the most boring trade to sit in, because it was low probability. So you guys are going to notice all of these tendencies. And a lot of you guys, like, especially when I first started, I wanted to enter on the order block, the breaker block. I wanted to enter on everything. If you guys have this in place and you guys are serious about it, you guys are going in every day and journaling, how are you going to put in, I entered on a breaker, when that's not your model? Immediately, you're going to punch yourself in the face and say, why did I do that? Why did I enter that trade? So this is what it's meant for, guys. It's to help you get better, and it takes a few minutes out of your day. If you guys could do this right here, you guys will be profitable. I guarantee it. Just give it some time.